Welcome and thank you for joining our webinar today. This is Jyoti from My Time Equity, and we are all happy to have you with us here today. Joining us today are Sudhir Pai and Anup Nayak from My Time Equity. Before we begin, I would like to take a moment to introduce you to My Time Equity and Sudhir Pai. As an actively managed portfolio management and RIA firm, My Time Equity takes pride in being your dedicated partner on this financial journey, helping you to plan, grow, and preserve your wealth with confidence. Sudhir Pai is a founding principal of the firm and serves as a fiduciary investment advisor representative, bringing deep expertise in wealth management and tax efficient investing. Before I hand over to Sudhir, let me take you through the disclaimer slide that our attorney's mandate we show prior to every webinar. Kindly scan the QR code to join our My Time Equity WhatsApp community to get exclusive updates on equity markets, alternative investments, real estate, crypto ventures, and many more. If you have any questions during the webinar, please type them in the Q&A box and we'll be happy to address them during the discussion. If you like to connect with Sudhir after the session, you can reach us at wealth@mytimeequity.com or call us at 972-330-2771. Over to you, Sudhir.
Thank you, Jyoti, and good morning, ladies and gentlemen. Thanks for joining today's webinar. Today, the topic is beyond the rally and what's driving markets and what could break them. So basically, we'll be talking about this particular topic because we saw some amount of corrective behavior in all the indices. We saw S&P 500 and NASDAQ fall about 1.6% and 3% respectively. Bitcoin took a bigger beating, about 6% down, and the gold was flat. So the week before, it was the turn of gold and gold miners and silver. This week, gold and silver was pretty stable, whereas Bitcoin took it on the chin. So why did this happen? This happened because, we saw continuous uptrend, and always an uptrend has to be broken, and that's a sign of a healthy market. But is this breakage of trend more permanent or is it more temporary? Now that is very hard to say, but if you look at what happened on Friday, the S&P 500 large cap index touched the 50-day moving average and it bounced back. So yesterday was a green day after a couple of red days, which makes me feel that Monday is going to be a little bit of a corrective action again, because Friday it bounced back. And after that, we should be seeing an upside to all of the indexes as well as the individual stocks. Bitcoin has been positive for the weekend, and I hope that continues, because Bitcoin touched, a significant support level, and we hope that it is going to pick up from here and going to continue with its uptrend. And gold has been stable, and I hope that it continues to be stable on Monday, because if stocks take a beating, usually golds are positive. And after that, we should see some corrective action in gold and silver, because it has had a huge run up in the last 3 months. Coming to the rate cut, there is a 70% chance of a December rate cut. That's because, the labor markets are softening and inflation is unknown right now, because the reports from the government departments are not getting issued because of the government shutdown. And government shutdown has been going on for a long period now, and it started affecting a lot of day-to-day working. And due to lack of reports coming from all the departments, there is difficulty in taking certain decisions by the Fed and other administrative teams. And gold reached a 4-month high. Usually when dollar reached a 4-month high, and usually when dollar goes up, stocks end up going down. And the logic is that when dollar is going higher, people end up keeping money in their bank accounts, earning better rate of interest, as well as enjoying the appreciation of the dollar. And with the dollar uptrend, we saw the long-term yields on bonds also to be going higher. Now, when dollar and bonds, the yields are higher, that's when stocks take a beating, and hopefully this should get arrested next week and we should see equities again starting to rally. Coming to earnings of the S&P 500 companies, excellent earnings. Few small and mid cap companies have been not great on in terms of giving guidances. We saw some stocks like Lululemon and Uber and many stocks, really take hugely because of the guidance. And these days, stocks get punished severely, if they miss something very small, and that is because we are at a very inflated asset price, and if there is any kind of doubt that this market is inflated beyond the fundamentals, suddenly you will see a drawdown, and that takes place at individual stock level, then finally affects the indexes. So earnings are good, 13% growth so far, and the growth earnings for 2026 stands at 16% year on year, which is excellent results that are coming out of all the tech companies as well as all the Magnificent Seven companies and many other companies, except for few small and mid-sized companies. So we had a good intraday bounce on Friday, which makes me to believe that next week can be a green week, unlike this week, which is a big red candle with about 1.6% down on S&P 500. Next slide, please. Okay, so it is not just in the US that we are in a bull market. We have been in bull market globally. If you look at these three lines on the graph, one represents developed markets and one represents emerging markets, and the blue line represents US. So the blue is at the lower end, and developed and emerging markets are higher than that. And if you look at the numbers, for the year, so far, developed markets has generated about 34% return, whereas emerging markets have returned about 27%, while S&P 500 is about 14%. So that tells us that this is not just specific to US and Mag 7, but globally, we are seeing asset prices increase, stock prices increase, and as I always say, it is the worst thing to do is to keep cash in your bank account or put it in CDs. Money has to be invested in multiple different assets, starting from real estate, stocks, and cryptos and metals. So please make sure that you are not sitting on the sidelines, particularly if your money is for the long term. You need to put that in the market, otherwise your money will become cheaper and cheaper day by day. And this chart is a very clear representation of that fact, that global equity participation is extremely healthy, and this is not just limited to US large caps. So we are seeing a global bull market going on right now. Next slide. Now coming to corporate earnings, why is this rally going on? This rally is going on because corporate earnings are excellent. And if you look at all the 11 sectors of S&P 500, which starts from technology and ends with energy on the slide, energy is the only one that is running negative. Other than that, real estate, financials, communication services, materials, consumer discretionary, industrials, all the sectors are generating excellent EPS, earning per share. While revenue growth is also no less, even that is doing extremely well. And the delta between the two, which is called as margin expansion, and that is because, with higher pricing, higher revenue and higher pricing, the indexes will expand in terms of their overall size. And this margin expansion is what will help us, to generate a much higher asset price and a very stable market going forward. So while there are a lot of bears in the market who are predicting a huge bubble crash and things like that, I think it's too early in the game. It might happen sometime in end 2026 or early 2027. Nobody has a crystal ball, but based on the way AI is progressing right now, if you look at what is going on, data centers are still being built. And the biggest challenge that we have for the data centers is energy, and they are figuring out how to manage energy. So when the bottom line infrastructure is yet to be built, the bubble cannot burst so soon, right? Now, the only thing that can change is huge unemployment, which I don't think personally is going to happen in 25 and 26, because AI is yet to attain a level of maturity where existing teams are losing jobs. Right now what is going on is the lower end jobs are not getting hired because Chat GPT and a lot of the AI tools like Gemini, they can do a lot of junior level jobs. Efficiency has increased with some of the AI tools already, but for it to see mass layoffs, we have to see AI mature further and robotics to come in place. So with all of that, what you get to see here is broad participation in the market. 7 out of 11 sectors have seen expanding margins, and these are led by financials, real estate, technology, and material. Like I have been saying always, real estate has been in slumber from the last 3 years. So this is the time, I think, to invest in real estate, because interest rate cuts are about to happen at a significant percentages multiple times over next year, particularly after Fed Chair Jay Powell retires, and one of the Trump administration folks become the Fed Chair. We may see 50 basis point cut in Q3 and Q4 of next year. You never know, because Trump is very clear that inflation is falling, and it is really falling because housing expenses are falling, oil prices are falling. So with all of that, inflation should get arrested, and as long as unemployment number really don't show a big delta versus the previous years, I think we should be good in terms of not having a big corrective action in the equity markets, and this bull market may continue at least for the rest of this year in 2025 until mid of next year. February is usually a weak month, so I am very positive till January. Corrections may happen. 3 to 4% corrections are always welcome, but a bigger correction, which is like about 20% correction, like what happened during the Liberation Day, those corrections, there has to be real reason why such corrections should take place. But otherwise, corporate earnings are great. Almost 70% of the companies have announced their earnings. Everything looks good. The next 2 months will be Thanksgiving, and after that Christmas. Consumer sentiment should improve, and we should see a big rally in the market, and hopefully all our portfolios do extremely well in the next 40 days. Next slide, please. So I touched on this. Housing inflation is coming under control, and we are seeing that very clearly on the chart. So that's a good news, and this is one of the gauge for Fed to lower interest rates. So hopefully, December cut, while he said that it's not a foregone conclusion that interest rate cut is 100% going to happen, he made it slightly doubtful. But there is a 70% chance right now, as per the poly market and the other betting markets, that interest rate cut of 25 basis points will happen in December. And markets are clearly not sure about it, but the betting markets are saying that. So hopefully that should happen, and we should see that as another reason for the market to turn back up, particularly for financials and small caps and metals. Next slide, please. So we shared this slide last week also. So if we see strong months till October, May and October, then we end up seeing excellent November and December. So the median return, out of 6 instances since 1928, you can see 6 different years where we saw May to October being positive months. We ended up, those years ended up with 2.4% return in December and 2.5% return in November, totaling up to 5.4% return, for the 2 months that are in front of us. So 2025, based on all these historical numbers, past performance is never indicative of future numbers, but that is the guide that we have. Looking at the data, looking at the past, we can certainly feel comfortable. And looking at the bounce that took place on Friday, we can feel comfortable that the next 40 days has to be hopefully positive, and we may make about 5.4% on the S&P 500 index. And I also showed you how the global markets have done in this year. They have done better than US, and US I don't think would want to stay behind when you compare it to emerging markets and developed markets. So I think there is going to be this big push in November and December, and we may see an excellent next 40 days before the year ends. Next slide, please. Coming to data, these days we don't get too much of data because of government shutdown. There is otherwise, CPI numbers have to come up next Thursday, and then initial jobless claims. These days for jobless claims and employment numbers, we are depending on ADP and Challenger reports. Hopefully this government shutdown should end by end of next week. That is what the betting market shows. And as per my prediction, which I have been sharing over last 2-3 weeks, is we should see some kind of corrective action in the equity markets between now and November 18th. And I think this will coincide with the government shutdown, ending, and that should be in about 10 days from now. So I think the next 10 days we have to be patient. We have to get used to seeing some red candles, and then hopefully, we will see a lot of upside movement in all the asset classes, right from Bitcoin to metals to, equities. Next slide, please. Okay, so our models, as you can see, did not perform as bad as or as good as S&P 500. S&P 500 was negative 1.6%, while Nasdaq was negative 3%, and our models were between 2 and 3.3%. And that's because we are heavy growth, and we are heavy compared to S&P 500 and Nasdaq. We have about 8% in crypto and about 8% in metals. So with all of that, we really took a little bit of extra redness in our portfolio for the week, but still we are ahead of what S&P 500 has done. And I'm sure when this market bounces back, we will bounce back much faster because of the assets that we have in our portfolio. Next slide, please. Okay, we sent out this email about tax and retirement strategies yesterday to all our clients. So I'm sure you would have received it. If you have not received, that means you're not in our database. So please join the WhatsApp group, as well as send an email to wealth@mytimeequity.com, and we'll add you to our database. This email shows how a business owner can lower their income tax for 2025. A lot of depreciation can be taken against your business income. For W2 recipients, there is a limit of $626,000 that you can take against depreciation for the year 2025. But for business owners, there is no such limit. You can, if you have $5 million in net income, then you can have $5 million of depreciation, and you can make it zero. So you can also put your money into retirement plans. 25% of your compensation coming from your business, up to $70,000 can be invested in a SEP IRA. And if you have a solo 401k, where employee and employer contribution put together can be 70,000 plus as well. Now, for business owners with 5 million plus revenue, we can set up a cash balance plan or a defined benefit plan, where each member, let's say it's a husband and wife entity in IT consulting, you can deduct up to 400K per member, depending on your income and age. So you can also contribute up to $2.8 million per year for lifetime towards your defined benefit plan, retirement plan. So defined benefit plan, think of it like a Cadillac plan. This is only available for business owners, not for W2 recipients, unfortunately. W2 recipients, please maximize your contribution in your employer 401k plan. But if you have your own business, you can put in a lot of money in your private retirement plan, also called as defined benefit plan or cash value plan. You can also set up a private foundation for doing your own charity. You can call it with your first name, last name, and call it private foundation or charity. You can contribute a lot of money to that, up to 30% of your adjusted gross income, and that can be eventually used to doing true charity. So you can park the money aside and take benefit of lowering your tax for 2025. and then do the real charity later. So till such time it can keep generating returns for your private foundation. We also can set up a risk mitigation insurance plan, which can write off up to $2.8 million for 2025. This is a beautiful plan. Again, all these are good vehicles for business owners with revenue of $5 million plus. Next slide, please. Okay, and for real estate investors, so if you have your own rental properties and apartment complexes or any of real estate investments that you personally have made, you can also apply for cost segregation and generate a lot of accelerated bonus depreciation and take that against your W2 income or business income. Now there are a lot of rules and regulations around taking real estate depreciation against your income. So please talk to your CPA or tax preparer about that. That's not in the scope of my webinar, because that's more of a tax knowledge that you need to get. What I'm sharing here is very high level information on what all you can do. And the other planning idea is to invest money in qualified opportunity zones. If you have a capital gain from sale of real estate or from sale of stocks or from sale of business, you can invest that money in qualified opportunity zone and not pay your tax till 27. Or if you're investing after 26, you don't have to pay taxes for 7 years. And all the growth of that money that you make as an investment is tax free. So it is like a mega 401k and a Roth plan. So beautiful plan. We have a qualified opportunity zone fund at My Time Equity. So reach out to us and we can help you with any of these ideas in terms of investments. And we can work with your CPA, in ensuring that, they do understand what we are talking about, and they are on board with us in terms of, preparing your returns when time comes. And for someone who has a huge capital gain, let's say $1 million plus capital gain, either from sale of business or stocks, we have a strategy where you can invest $1 and write off $10 in capital losses. So let's say you have a $5 million of capital gain from sale of your NVIDIA stock or sale of your business or sale of something, that $5 million, the way you can make it zero is by investing $500,000. So it's a beautiful program, complex, not as simple as it sounds when I'm saying it here, but we can implement this for you within the next 40 days if you have such a large capital gain. For capital gain with $2 million plus, it makes sense. Otherwise, qualified opportunity zone funds is your best bet in terms of implementing it for this year. Now we have other ideas too, like donor advisor fund that we can open with Charles Schwab for smaller charitable funds, as well as private foundations for your family charity and launching that for doing real charity in the future, as I mentioned previously. Next slide, please. Now, all of these is available on My Time Equity PE website. So our private equity firm, My Time Equity Private Equity, is the place where you can find all of these investment opportunities. We have the Florida Farmland Fund, which has a potential to write off 4 to 5x of your investment. We have the My Time Equity Income and Growth Fund, where you can write off 2.2 times of your investment. Then we have oil and gas funds, where you can write off between 75 to 80% of your investment in 2025. Then we have the beautiful Tiffany Green Homes, which is generating about 60% depreciation, about 5% income, and then potential appreciation. And then we have the car wash funds and all the pre-IPO opportunities like Polymarket, Databricks, Mistral. We have all of that open right now. And last but not the least, we also posted a short-term rental opportunity in Florida, in Panama Beach. Beautiful opportunity. 80% loan can be obtained from the bank. You'll make about 5 to 6% return cash flow every year. And the growth of that area is phenomenally good. So we are buying about 3 homes, and next year we are planning to buy about 17 more homes, making about 20 homes and creating a larger asset base in Florida. And as most of you know, with the recent win in New York, a lot of people from New York are leaving for Florida and Florida real estate is going to very soon see a continued boom. So it is better, we park some money in Florida because the rental incomes are good, the growth is good, and this particular real estate that we have found, this area has not seen hurricanes for the last 70 years. So quite a safe area and a lot of benefits. But the property that we have online, that is almost gone. I think it's taken by a few investors because next 40 days there is a lot of interest in investments because the year is ending. So if you are serious about investing in 2025, please reach out to us. And if your interest is in knowing about this, my request is please read through the website and reach us out in 2026. So we can help those who are in serious need of investing this year, and rest of it we can handle it next year. Next slide, please. Now coming to structured notes, we have about 6 structured notes. This one I just posted this morning. We just got access to this. This note is from Morgan Stanley. It's trading on November 14th. We have 3 ETFs here. One is semiconductor ETF, one is communications, and one is financials. All 3 are set to explode in terms of growth because of whatever we talked about some time back. And this is a 3-year note, and you get to make 2.6x or 260% of the lowest grown ETF. As always, when you have multiple stocks, multiple ETFs, the lowest of the 3 is what you get in terms of return, and you get 2.6 times of that. So very good note, particularly on index, and it has a 20% 40% barrier. So that means as long as all of these 3 ETFs are above 60%, you don't lose any money. And it's a 3-year note, and it's growth note. So it's not income note, it's not snowball note, it is pure growth note, and in 3 very good indexes which are heavily in terms of size, huge ETFs from SPDR and VanEck, a semiconductor index. So this is a good note to park a little bit of money if you are positive about semiconductors, which is basically Nvidia and all other companies, communications, Meta and other companies, and financials, JP Morgan and other companies. So take a look at this, and the trading date is November 14th. Next slide, please. This note is on Netflix because Netflix took a little bit of beating, and Netflix has also announced a split issue, 10:1. We launched this note last week. This is trading on November 12th, so 4 more days. So if you are interested in investing in either of the note, one is a note with Goldman Sachs, one is with Morgan Stanley, one has got Broadcom and AMD, one has got Robinhood and Oracle. Now the beauty of these notes is, we are investing when the market is down. As I said, S&P is down. Friday it was okay, but we don't know how it will be on Monday and Tuesday. So if the market continues to be down, we are locking in a lower price, which is actually good. So we want the market to be at this price or lower, when we buy these notes. And it's a 3-year note with a 50% barrier. And the beauty of this note is at the end of year 1, if all these stocks are positive, you make anywhere from 70 to 125% in 2 different notes. And at the end of 3rd year, if the first year conditions are not met, then you make anywhere from 4.4x to 3x of the lowest performing stock. Again, diversification, put some money in the previous one, put some money in these ones, so that your portfolio is diversified and you have 50% barrier on the downside. So that you can sleep well at night, and the returns are also not tiny, right? The 70 to 125% is not small. One of our note got called, which had Meta, Google, Tesla, and Nvidia. That note made 50% return for our clients, and none of these 4 companies have made 50% year to date. So beauty of having multiple tickers in one note is we can negotiate heavily with banks. If we get a note just with Netflix, we can't negotiate a 70% return at the end of year 1. By adding AVGO and AMD, we were able to negotiate 70% return from Goldman Sachs at the end of year 1. And mostly, these notes will get called because markets are in the uptrend. And if things continue like this in 2026, by this time, on November 13th, 2026, you will end up getting 70% and 125% return, and your money will be returned back to Schwab account. So a good note which has good upside at the end of year 1, at the end of year 3, and downside protection of 50%, and always liquid. Anytime you want to sell it, just email us and we can exit out of it in 3 days. Next slide, please. So this note is a principal protected note. We shared this last time as well. So we have 2 notes here, one with Palantir, Micron, and Dell, and one with Broadcom, Tesla, and Crowd. So we got a request from our client saying, can you add more stocks? So which is an excellent feedback, and we took that feedback. So we are adding a lot more stocks because the market is down right now, and this is the right time to put money when the market is down. So the November 7th note is gone. So November 12th note is still available, and it's principal protected. It's a 5-year note, and you make 1.25x at the end of the term. Or if it is not going all the way to the end of the term, then you make 40% in second year, which is like 20% per year, which is not bad for a principal protected note. And then 1.25x at the end of 5th year. And if in the 5th year also, if all the stocks are down, then your money is returned without any loss of capital. Again, little conservative, and but still a decent upside, because the stocks that we have chosen are all awesome, innovative and highly volatile and technology growth stocks. 12th November is the time for this. Next. Okay, this is an index note. At a request of a client, we launched this. The client wanted to invest only in S&P and Nasdaq. So this note is on these 2 tickers. You get 22% return in 1 year at the end of year 1, or if it continues to go till the end of the term, which is 4.9 years, you make 1.4x of your growth. So at the end of year 1, you either make 22%. If that condition is not met, then it goes to 59th month, and you make 1.4x of the actual return of the lowest performing index. November 14th is the deadline for this. Again, a lot of investment opportunities, folks. The reason why we work so hard in bringing all of this to you, so that you have a choice, you diversify your investment, because I really don't know how the future is for the next 3 years, 4 years. So the only best thing we can do to protect our capital is by diversifying it against multiple assets and multiple different banks, multiple different stocks, multiple different structures, and that is what we are doing here. So please spend time in understanding what we talk and making a decision on how to invest. Don't get very greedy with the stock market, because a lot of people I see playing in options. Now these structured notes are based on options, so instead of trying to play it yourself and losing money, you should maybe invest in these, because these are guaranteed by the banks, and the trading desks of these banks are far more resourceful and superior, and they are the market makers, so they have a lot more information than we do. So it is better to be happy with the returns that we make out of these notes, and sleep well at night. Next slide. So this is an income note. Here we have 18% income, and so the monthly coupon is 1.5%. So 18% is an excellent rate with a 40% downside protection, and the stocks are Palantir, Tesla, and Nvidia. Even this is trading on November 14th. So most of it will all be closed on November 12th and 14th. So you have 1.5 days of free time today and tomorrow. Please sit, look at your cash balance, and decide where to invest, and write to wealth@mytimeequity.com and let us know ASAP. Next slide. Next slide, Jyoti. Okay, I think
This is the last slide.
Yeah, I think we come to the end. Anup, you want to take questions?
Yeah, I'm just trying to see if there are any questions there. So far, I could not see any questions.
No
Unless
question. Questions means all our listeners are extremely intelligent now because we have been doing so many webinars from last 1 year. So that's excellent. So yeah, but please do reach out to us. We are available all the time. We have our new office here in Plano, and all of us are working from office. Yeah, I am not traveling anywhere, so please do come and visit us. I see a few questions popping up now.
Yeah, there is one on S&P index in an AI bubble, right? I think there is an exact reason why you spoke about barriers and protection, Sudhir. So yeah, you can please comment on that. I keep hearing
So,
that S&P. Yeah.
based on valuations, we are in a bubble, but bubble does not burst so soon. Bubble takes time. It gets stretched and stretched and stretched, and that's when it bursts. So we are in a bubble because if you're getting a valuation of 30, 40, certainly we are in a bubble. And as Anup said, because we have the higher valuations, we are going a little conservative by bringing the structured notes. So either you should look at this as a long-term investment and not worry about day-to-day news and worry about bubble getting formed, because let's say there is a bubble and it bursts like in 2008 and it comes back up in 2 years. Now, if this money that you need is not for your day-to-day life today, then the question is, why do you care whether it's a bubble or a bubble gum, right? Just doesn't matter. It's okay. It can grow, it can burst, it will come back up, because when something goes down so much, it comes back up very soon these days, because the retail is really very active in the equity markets now with Robinhood and all these other tools. So we are seeing V-shaped, K-shaped recovery from the last 3 years, and with the money printing that is going on, and with the knowledge that the world is imparting through artificial intelligence, chat GPT type tools, YouTube type videos, podcasts, people are becoming more intelligent, and they are thinking before investing. They are hedging their portfolio, they are buying structured notes, they are investing in private equity and things like that, and nobody is trying to be impatient by taking the money out immediately, right? So we are in a bubble, you are right, but the bubble burst, in my personal opinion, is yet to take time. And if you look at the formation of bubble in 2000 dot-com burst, the bubble started getting created in 1998. But when did it burst? It burst only after Y2K, right? Then again, then Fed pumped a lot of money, and then again 2002, it again burst, and again Fed pumped more money, and then it was all fine till 2008, till we had a financial crisis, which was a lot of fraud involved, and that is when regulation came into finance. And that regulation has been in place, and we are going to see deregulation now in 25, rest of 25 and 26. Now, once the deregulation takes place, that's when a lot more frauds will pop up, and then sometime in 27, I think you may be able to see the bubble burst again. If there is a quick correction of 15-20%, like what happened during Liberation Day, then obviously you are automatically seeing a big correction and then coming back up. So these kind of corrections will ensure that the bubble does not become huge and burst very soon, because these kind of corrections really help some of the froth to be going out of the market. So April, that happened. That may happen again in February, we don't know. But if you're a long-term investor, you should not worry. If you're buying a structured note, you should not worry. And if you are an active trader, you should not worry. I think those are my answers to the bubble question.
Thank you, Sudhir. And as you said, majority of our structured notes are at least giving 40% protection. What more, right? So that is the one. Right? Okay.
Yeah. And 40% protection with a 3-year window, and in that time, we also see a lot more barrier getting added, right? Like, for example, when we did Palantir note in 2024, today Palantir is up 130%. So we have the 50% barrier plus the 130%. So it's almost 180% protection we have on Palantir, right? Which we got issued in 2024. So like that, there are checks and balances falling in place. And one of the reasons why we bring so many, instruments is so you can diversify. Now, the problem of diversification is you'll have to have a lot of items in your Charles Schwab account, and you have to understand, you may get worried that there are too many line items in your account. But the good thing is, if something goes bad, then it's not just It's not that all the things have gone bad, right? It's just one of them or two of them. So diversification is the key. Investing in multiple asset classes is the key. Investing in multiple countries is the key. Multiple structures is the key. So, if you want to discuss with us about your entire portfolio or your tax planning, then reach out to us and we'll be more than happy to get into details just for you and take it from there. Folks, thank you very much for joining today's webinar. There are no questions, so we will end the webinar early today. But if you have questions, please email wealth@mytimeequity.com and also join our WhatsApp group to get the latest on a day-to-day basis. Thank you very much and enjoy the rest of your weekend. Bye-bye.
Thank you.